All right, let's dive right into this. Welcome to the Explainer. Today, we're going to completely demystify the essential economic building blocks that dictate how businesses make their most critical pricing and production decisions behind the scenes. Seriously, if you've ever wondered why an airline might sell a seat for just a fraction of its normal price, or why a factory might keep running even if it's technically losing money on paper, you're in the right place. We're going to decode the alphabet soup of cost curves and look at the exact mathematical rules that determine a company's survival. Here is our roadmap for today. First up, the three basic costs. Second, we'll explain costs per unit. Third, the marginal cost function. Fourth, the rules for profit maximization. And finally, short-run market supply. We're going to build our knowledge from the ground up, so let's start with the foundation. Section 1, the three basic costs.
Let's start right at the absolute baseline numbers that every single business owner has to track. The most interesting concept here is inevitability. Before a factory even turns on the lights or produces a single widget, they're hit with fixed costs. Often called overhead, these are the expenses that simply do not care about your level of output. Think about rent, heavy machinery, or insurance. In the short run, these costs are completely inescapable. Even if your production is dead zero, your fixed costs are still staring you right in the face.
But obviously, a business can't survive at zero production forever, right? And as soon as you start actually making things, you introduce a brand new category: variable costs. Unlike those stubborn fixed costs, variable costs are entirely dynamic. They directly depend on the level of production you choose. So if you want to make more computer chips, you literally have to hire more labor and buy more raw materials, like silicon. While your fixed costs stay flat, your variable costs are going to steadily rise as you crank up your output. And here's how they come together to form your total cost. Just take a look at this. At an output of 0, our total variable cost is 0, but we still have a total fixed cost of $100. When you add your total fixed costs and your total variable costs together, you get your total cost. Notice that as output goes from 1 unit to 2 units, the fixed cost is completely frozen at $100. But the variable cost jumps from $20 up to $38, pushing our absolute total cost up to $138. Okay, moving on to Section 2, costs per unit explained.
Now that we've got our total numbers down, let's slice this all into averages to understand what's actually happening on a per-unit basis. This is where the famous alphabet soup of economics really kicks in. By dividing our massive total costs by the quantity of output produced, we get three crucial acronyms. Average fixed cost is your total fixed cost divided by quantity. Average variable cost is total variable cost divided by quantity. And your average total cost is your total cost divided by quantity. What's super fascinating here is the concept of spreading overhead. Because your fixed costs are constant, as you produce more and more, your average fixed cost gets continuously smaller, approaching 0.
Visually, this is pretty striking. It perfectly illustrates how average total cost and average variable cost move together. See, the vertical gap between the total cost curve and the total variable cost curve is always exactly your fixed cost, in this case, $100. Because fixed costs are constant, that raw distance never changes. But when we look at the averages, that fixed cost gets spread out over more and more units. That means your average total cost and average variable cost curves are going to get closer and closer together as production increases, even though they'll never technically touch. Let's move to Section 3, the marginal cost function. So averages are great for a high-level view, but businesses actually make their most critical, split-second decisions at the margin. This is the dynamic element of the whole thing. To really understand the margin, we have to ask a very specific question. What does exactly one more unit cost to produce? Think about this real-world anecdote. Imagine an airline flying from New York to San Diego. A regular ticket costs $500, but they offer a standby ticket at the gate for just $50. Why on earth would an airline offer a $50 seat for a $500 flight? Well, the answer's all about the margin. Marginal cost is simply the exact increase in total cost that results from producing just one additional unit of output. Here is the secret to that airline's pricing strategy. Their fixed costs, the plane, the pilots, the runway fees, are already fully paid for, regardless of whether that last seat is empty or full. So your marginal cost reflects only the changes in variable costs. For that standby passenger, the airline's only additional cost might just be a tiny bit of extra fuel weight and a bag of pretzels. If that extra cost is only $20, selling a standby ticket for $50 actually increases the airline's overall profit. It's kind of brilliant. Now let's look at the shape of this marginal cost curve, because it's really important. In the short run, a firm is constrained by fixed inputs, which eventually leads to diminishing returns. As you push your factory closer to its maximum capacity, it becomes increasingly costly to squeeze out successively higher levels of output. This sends your marginal cost curve skyrocketing upward. Now pay close attention to exactly where this skyrocketing curve crosses the others. It slices perfectly through the exact minimum points of both the average variable cost curve and the average total cost curve. The mathematical relationship happening here is beautifully simple. Think of your marginal cost exactly like a final exam grade in a college class. If your grade on the final exam, which is the marginal unit, is lower than your current average, it pulls your overall average down. But if your final exam grade is higher than your average, it drags your average up. That is exactly why the marginal cost curve must intersect the average curves right at their minimums. It is the exact pivot point where the mathematical pull switches from down to up. Section 4, Rules for Profit Maximization. All right, we have our cost curves. Now we crown them with the overarching rules of the market to solve the ultimate problem every single business faces: how to maximize profits. To squeeze every last cent out of a competitive market, you have to follow two strict mathematical survival rules. First is the first-order condition. A firm must produce at the exact output level where marginal revenue, which is the market price, equals marginal cost. But wait, that's not enough. There's a second-order condition, which is the sufficient condition for a maximum. The marginal cost curve must actually have a positive slope. It must be rising at that exact point of intersection. If you produce where price equals marginal cost and your costs are rising, congratulations, you've found the absolute peak of your profit potential. Finally, Section 5, Short-Run Market Supply. So what does this all mean for the real world? How do these mathematical cost intersections dictate a firm's actual behavior? Do they supply goods, or do they just shut their doors? Because any rational business will always choose to produce where the market price equals their marginal cost, this single upward-sloping marginal cost line literally becomes the company's supply curve to the whole world. But there's a major catch. It is only the supply curve for the portion that sits above the average variable costs. Why? Because if the market price drops below your average variable costs, you aren't even covering the immediate raw materials and labor to make the very next unit. At that point, it is literally cheaper to just shut down entirely. Let's summarize the firm's three possible short-run realities. First, the dream scenario, short-run profit maximization, where profit, let's call it Y, is greater than zero. This happens when you produce where the market price is strictly greater than your average total cost. Second, the break-even point, where profit Y equals zero. This occurs when the price exactly equals your average total cost. You're covering all your costs, so you stay in business to maintain market share. But finally, the shutdown restriction. A firm will immediately cease production if the price falls below the minimum average variable cost. At that point, every single new unit you make just digs your financial grave a little bit deeper. And that brings us to the end of our short-run analysis. We've seen how fixed, variable, and marginal costs create strict mathematical rules that dictate whether a business thrives, breaks even, or completely shutters its windows today. But while these short-run constraints dictate immediate survival, it leaves us with a really provocative thought. In the face of these rigid mathematical rules, how might businesses innovate and restructure their massive fixed costs to permanently alter these curves and achieve economies of scale in the long run? That is the ultimate challenge every growing business must eventually face. Thanks for joining me on this explainer, and keep questioning the curves behind the companies you see every day.